You are sitting at your kitchen table. It is 11:14 p.m. on a Tuesday in April. There is a cold cup of coffee next to your laptop, a pile of receipts you swore you'd organize in January, and a W-2 form staring back at you like a mugshot of your entire year. And there it is. Line 2, federal income tax withheld, $27,400. Gone, vaporized, sent straight to the United States Treasury before you ever touched it. You didn't write a check, you didn't authorize a transfer. They just took it. Every 2 weeks, like clockwork, the payroll system skimmed it right off the top. You worked 2,080 hours last year, and you stayed late. You answered emails on Saturday mornings while your kid was asking to come outside. You ate lunch at your desk and skipped the vacation you promised yourself. You ground through 12 straight months of alarm clocks, commutes, and fluorescent lighting. And when you finally sit down to look at what you actually kept, you realize that roughly 3.5 months of your life went directly to the federal government, not to mention what your state took, Social Security and Medicare. You worked until mid-April just to break even with the IRS. Everything before that was just free labor. Congratulations. And look, you've made peace with it. Kind of. You've been told since middle school that taxes are the price of civilization. Roads, schools, the military, fine, you get it. You're a good citizen and you pay your share. But then you are lying in bed at 12:30 a.m., doom scrolling, and a ProPublica headline hits your screen. Elon Musk, Jeff Bezos, Warren Buffett exposed tax records showing effective tax rates of 3.27%, and some years, literally zero. Bezos reportedly claimed a $4,000 child tax credit, while his net worth sat at $18 billion. $18 billion. And he is filing for the exact same credit as your coworker, the one with 2 kids in daycare just trying to keep the lights on. You read that and something cracks inside your chest. Not surprised because you already suspected it. What cracks is the last little piece of you that believed the system was at least trying to be fair. It is not. And here is what makes it worse. They're not cheating. That is the part that really grinds your teeth at night. They're not hiding money in shoeboxes or bribing IRS agents. They are simply following the law. Every single dollar they shelter, every tax bill they dodge, it is all perfectly legal, written right into the code and blessed by Congress, rubber stamped by the exact same government that garnishes your paycheck before you can blink. They're not breaking the rules, they're playing a completely different game, with a completely different rulebook, one that was never handed to you, one that was never mentioned in your high school economics class, or your college finance elective, or that HR onboarding packet, where they told you to pick between the PPO and the HMO. Like that was the biggest financial decision of your life. You were taught to work hard, earn a salary, and save what is left. And pray compound interest does something magical before you're 65. That is the playbook they gave you, and it is a trap. Earned income, the money that comes from showing up and doing your job, is the single most heavily taxed money in the entire American financial system. Trying to build wealth on a W-2 salary is like trying to fill a bathtub with the drain wide open. You're pouring water in, and the IRS is pulling the plug. The wealthy don't pour water. They don't even use the same bathtub. They use a 3-step strategy, passed down through dynastic families for generations. It has a name, and it sounds almost too simple to be real. Buy, borrow, die. 3 words, 3 phases, and together they form what I call the salary trap. The invisible cage that keeps W-2 earners bleeding money to the government, while asset holders walk through the tax code like it is a VIP lounge, with their name clearly on the list. By the end of this video, you'll understand exactly how this machine works. You're going to see why your 6-figure salary might actually be the very thing keeping you broke, and you'll learn how to start dismantling the salary trap piece by piece. even if your brokerage account only has $500 in it right now, because the game isn't going to change for you. Nobody in Washington is coming to save you. The only option left is to learn the rules they never taught you and start playing for real. Now let me tear down every comforting lie you've been spoon-fed since childhood, because the reason you're stuck isn't bad luck, it is bad programming. Lie number 1, work hard and you'll get ahead. I'm exhausted just saying it. Your parents said it, your teachers said it, your boss definitely says it, usually right before handing you a 3% raise. That doesn't even keep up with the 6% your grocery bill climbed last year. You worked 2,080 hours this year and gave up your kids' soccer games. You ate sad desk lunches, and the IRS took roughly 700 of those hours before you saw a dime. That is not getting ahead. That is running on a treadmill. Someone keeps tilting steeper while telling you the finish line is just around the corner. Hard work doesn't build wealth. It builds someone else's wealth. The W-2 is not a reward. It is a receipt for how much of your life you sold at the government's asking price. Lie number 2, debt is dangerous. This one makes me want to throw my laptop. Dave Ramsey's voice lives rent-free in millions of heads, screaming about cutting up credit cards and paying off your mortgage early. And look, for consumer garbage, sure, don't finance a jet ski, but the idea that all debt is evil, that is the single most expensive belief the middle class carries around, while you celebrate making an extra $200 payment on your mortgage. Elon Musk is borrowing $1 billion against his Tesla shares at roughly the same interest rate and paying zero taxes on that cash. You're shrinking your liquidity to feel responsible. He is expanding his empire to stay untouchable. You're not being smart, you're just being obedient. And obedience has a price tag. I call it the discipline discount. You save $6,000 in interest over 10 years by overpaying your mortgage. But you miss out on $24,000 in market gains because that money sat trapped in your walls instead of compounding in an index fund. You paid $18,000 for the privilege of feeling financially responsible. That is like buying a fire extinguisher for $18,000 just to protect a $6,000 shed. Lie number 3, save for a rainy day. Your savings account at Chase is paying you 0.01% interest. Inflation is running at 3 to 4%. Every single year, your safe money loses purchasing power. $100,000 sitting in savings in 2020 buys you roughly $88,000 worth of stuff today. You didn't save for a rainy day. You watched $12,000 evaporate, while the bank used your deposits to lend money to developers at 7%. They made money on your fear, and you lost money on your caution. The bank doesn't see you as a valued customer. It sees you as a cheap source of capital, with a thank you email and a lollipop at the drive-through window. Lie number 4, your home is your greatest investment. According to the Federal Reserve, the median American family has 66% of their net worth locked in their primary residence, 2/3, in one single illiquid asset that costs you property taxes and insurance, along with maintenance and interest every single month. You can't spend your equity at the grocery store or buy index funds. It just sits there, making you feel rich on Zillow, while you're completely cash poor in reality. Meanwhile, the wealthy family down the street owns that home too, but they also have $2 million in a taxable brokerage account that they can borrow against whenever they want. Your house isn't an investment. It is a storage locker for money you can't reach. Lie number 5, the system will eventually get fixed. No, it won't. ProPublica leaked IRS data showing that the 25 richest Americans paid a true tax rate of 3.4% over those 4 years. You paid more than that on your last freelance check. Congress has known about buy, borrow, die for decades. They haven't closed it because the people who write the tax code And the people who benefit from it eat at the same restaurants in Georgetown. Waiting for fairness is not a financial strategy. It is a bedtime story for adults. Every single one of these beliefs was designed to keep you predictable. Predictable workers, predictable taxpayers, predictable consumers. The discipline discount isn't a mistake in the system. It is the system, and it costs the average household tens of thousands of dollars per decade in lost wealth they never even realize is missing. All right? Let's get into the actual mechanics, the real numbers, the stuff that makes this go from a nice theory to a weapon. Here is what I'm calling the compounding tax wound. It is not a one-time cut, it is a bleed. And it has been draining you every single paycheck since your first job at 17. Let's run the math, because the math is absolutely disgusting. You make $85,000 a year. Decent salary. You're not rich. You're not poor. You're that sweet spot where the IRS loves you the most. Between federal income tax, state tax, and FICA, you're handing over roughly $25,000 a year, 25 grand gone, before you buy a single egg. Now here is where it gets violent. If you took that $25,000 and invested it at a historical CP 500 average of around 10% annually, over 30 years, that is not $750,000. That is over $4.1 million. That is what the tax drag actually costs you. Not 25 grand a year, $4 million over a career. That is not a tax bill. That is a house in cash. That is retirement at 50 instead of 67. That is the life you were supposed to have. And the person sitting across the table from you at the same net worth, they paid close to zero because their wealth isn't income. It is appreciation. And appreciation doesn't get taxed until you sell. So let me walk you through how this works at a scale you can actually touch. Step 1. You stop worshipping your 401k like it is the only tool in the shed. Look, your 401k is fine. Max it out if your employer matches. Free money is free money. But here is what Fidelity and Vanguard don't scream from the rooftops. You can T-borrow against your 401k in any meaningful, flexible way. You're locking your money in a government-controlled box until you're almost 60. Try to touch it early. 10% penalty plus income tax. That is like putting your cash in a safe and handing the key to the IRS. The wealthy build taxable brokerage accounts alongside retirement accounts. Why? Because a taxable brokerage account is the engine of buy, borrow, die. You buy index funds, they grow, and you don't sell. You borrow against them through a securities-backed line of credit, sometimes called a pledged asset line. Banks like Schwab and Interactive Brokers, they offer these. Rates right now hover around 5 to 7%, depending on the amount. High, sure, but your portfolio is averaging 10%. You're still netting 3 to 5% on money you're spending. You're literally getting paid to live. Step 2. Your house is not a piggy bank you fill up and admire. It is a balance sheet asset you leverage. The average American home has about $300,000 in equity, just sitting there. Sitting, doing nothing, appreciating at maybe 3 to 4% a year, while inflation eats it alive. A HELOC lets you pull that equity out at current rates around 8% and deploy it into something that returns more. A rental property cash flowing $500 a month, or an index fund compounding at 10%. You're not spending that borrowed money on a boat. You're buying another asset. Asset buys asset buys asset. That is the loop. Step 3. You need to understand tax loss harvesting like it is a second language. Every year, the market dips. When your holdings drop, you sell the losers and book the loss, and immediately buy a similar but not identical fund. That loss offsets your gains. You can write off up to $3,000 against ordinary income every year and carry forward the rest indefinitely. It is not sexy, and it is not a TikTok hack. It is the equivalent of picking up $3,000 bills off the sidewalk every December that everyone else just walks past. Now you might be thinking, this sounds like a lot of juggling for someone who works 50 hours a week and barely has time to meal prep. I hear you, but here is the aggressive truth. The juggling is the job, managing your capital is the work. Every hour you spend learning this replaces tens of thousands of dollars in future taxes. One Saturday afternoon, understanding securities-backed lending could save you more money than a $10,000 raise. That just gets taxed at 32% anyway. The IRS doesn't reward effort. It doesn't care that you pulled a double shift. It rewards structure. It rewards the person who set up the right accounts and bought the right assets and never hit the sell button. You are not being taxed because you earn too much. You are being taxed because you earn the wrong way. And the difference between those two sentences is about $4 million over your lifetime. And here is the part that is going to sting because I'm not going to sugarcoat this. You heard everything I just laid out. Buy, borrow, die. The mechanics, the math. The loopholes wide enough to sail a yacht through. You understand it now intellectually. You get it. Congratulations. You know exactly how the game works. And you're still going to do nothing. You're going to close this video and you're going to open Instagram. You'll scroll past 3 ads for luxury watches and a reel of some 24-year-old in Dubai next to a Lamborghini. You're going to feel that little burn in your chest. And then you are going to set your alarm for 6:15 a.m. Drag yourself to the same desk, open the same laptop, and log into the same payroll system that skims 35% off the top before you ever see a dime. And you'll tell yourself you'll figure it out later. Later, that is the most expensive word in the English language. Later is what you said 3 years ago when you first heard about index funds. Later is what you muttered when your buddy told you about that duplex, the one for $180,000 that is now worth $310,000. Later is the sound of compound interest dying in your hands. Here is what is actually happening right now. In this exact moment, you are choosing an identity, not a strategy, not a portfolio allocation, an identity, and the identity you've been wearing your entire life. The good employee, the responsible saver, the person who pays their taxes first and asks questions never. That identity is a coffin. It is lined with direct deposit receipts and old 401k statements, the ones you haven't checked since 2021. It feels safe in there. It is warm. HR sends you a birthday email every year. But it is still a coffin. The person sitting across from you at that kitchen table. The one staring at the W-2. That person doesn't have a money problem. They have a mirror problem. They keep looking at themselves and seeing a worker. Someone who earns. Someone who deserves a paycheck. And that self-image is the most profitable thing the IRS has ever taxed. Because it keeps you voluntarily walking into the slaughterhouse every April with a smile and a TurboTax subscription. You want to know why this makes me tired? Because the information is free. It has always been free. Buy, borrow, die isn't classified. It is not locked in some vault underneath Goldman Sachs. It is in tax law textbooks. It is in public SEC filings. Jeff Bezos' accountant didn't sign an NDA with God. The playbook has been sitting on the table your entire life. You just never picked it up because someone in a 9th grade economics class told you the system was fair, and you believed them. You're 34 years old, and you still believe them. That is the real scam, not the step up in basis, not the securities-backed credit line, not even the capital gains deferral. The real scam is that they convinced you your obedience was virtue. They made you proud of your W-2. They made you feel responsible for handing over 4 months of your life every year to fund a system that was specifically, architecturally, legislatively designed to let the person with 10,000 times your net worth pay less than you. And you said, thank you. So no, I'm not going to end this with some warm, fuzzy call to action. I'm not going to tell you it is going to be okay, because it is not going to be okay. Not if you stay who you are right now. The version of you that exists at this moment. The one who flinches at the word debt. The one who thinks a savings account is an investment. The one who budgets in spreadsheets but never builds in assets. That version of you has to die. Not tomorrow, not after you do more research. Tonight, before you go to sleep, you have to look at that person in the mirror and say, you were wrong about all of it. The rules you followed were written for someone else's benefit. And I'm done. Because here is the brutal, ugly, honest truth that nobody is going to tell you. The tax code doesn't care about your feelings. The market doesn't care about your work ethic. And compound interest doesn't care that you were tired. It only cares whether you showed up. If this rewired something in your brain today, hit that like button and subscribe. I'll see you in the next one.